Welcome to Spotify Exodus Investor Alert. This video, created by Kimi AI, was last updated on August 5th, 2025. We'll be examining key financial indicators and market trends concerning Spotify's performance. We begin by exploring user flight signals, which indicate potential user disengagement or departure from the platform. Despite overall growth to 713 million monthly active users and 281 million subscribers, Spotify is experiencing its slowest Q2 growth since 2021, with only 18 million new MAUs. Key markets like North America are stagnating, and churn is increasing after August 2025 price hikes. Price hikes of 9% across 40 markets led to a modest 1% RPU uplift to 4.57 euros. However, premium cancellations rose by 12 basis points, suggesting price elasticity is reducing the lifetime value per user. Next, we will analyze the monetization gaps, highlighting areas where Spotify might be underperforming in generating revenue. Ad-supported revenue has declined for 2 consecutive quarters, falling -0.66% year-over-year in Q2 and accelerating to a 5.5% decline in Q3. Spotify always had a higher quarter year-over-year, but now is flat for 2 years. Subscription growth is decelerating. While Q3 2025 saw a 11.5% subscriber surge, Q3 2025 premium revenue growth was only 8.8%. Future guidance implies an 8 to 10% growth for 2026, indicating limited operating leverage from new users in lower RPU regions. Now let's look at the profit red flags, which signal potential issues affecting Spotify's profitability. Gross margin expansion is stalling, with Q3 at 31.6%, a plus 5.3 basis points year-over-year, which is the slowest improvement in 5 quarters. Anticipated 2026 headwinds, including music label renewals and podcast minimum guarantees, could erase 200 basis points, keeping operating margins below 10%. In Q2 2025, Spotify reported an EPS miss of -0.42 euros versus a consensus of 2.11 euros. While Q3 recovered with a net profit of 899 million euros, this volatility raises concerns about the sustainability of expected 14% plus net margins in 2026. We will now examine cash and valuation stress, focusing on Spotify's cash flow and market valuation. Record trailing free cash flow of 2.92 billion euros was flattered by temporary factors. However, the 2026 outlook projects a growth deceleration from normalized working capacity and higher advance renewals. Limited buyback firepower could weaken stock support. Finally, we conclude with a retail investor takeaway, providing actionable insights for individual investors. Key risks for retail investors include price-elastic churn, adtech execution challenges, music label cost inflation, legal overhangs from streaming fraud lawsuits, and currency swings in emerging markets. Price-elastic churn poses a significant risk, as users may cancel subscriptions due to price hikes, impacting long-term profitability. Each risk could cut 5 to 7% from fair value. Our action plan is reducing overweight positions and waiting for evidence of an ad revenue turnaround and churn stabilization below 3% before re-entering the market. Treat Spotify as a show-me story. Right now, if you do a DCF, it's at fair value. So a multiple increase would be hard, so it's likely to grow only 20% year-over-year.